Hello, welcome back to the channel. I hope you are doing well today. In this video, I'm going to be unpacking the impacts of the interest rate increase. The Fed has recently announced that there will be an interest rate increase in order to fight inflation. In order to tackle inflation, the Fed will have to raise the rates. And this has gotten so many people, panicking. This is something that a lot of Americans are just, wondering, okay, yeah, inflation is bad, but do they really have to raise the rates? And what should we expect? What should we do? What will the impact be? So in today's video, I'm going to be talking about, the good and really getting into the ugly. We're going to spend some time talking about the bad side, the downsides of this interest rate increase, but not to make you panic, not to incite fear, but just to get you prepared and just to get you ready. That way you are crystal clear of what you will have coming your way, and then prep yourself up and just stay ready. Always stay ready so you don't have to get ready. That's the goal of this video. But before we dive in, if this is your first time stopping by this channel, welcome. Consider subscribing now to join this amazing community to stay informed on the helpful tips for your financial wellness and success. So, why is this a big deal? You may be wondering, why is the interest rate a big deal? We've talked about inflation. We've talked about what the Fed is trying to do to cut down prices, but there's a price to be paid. This comes at a cost, and we're going to talk about the real cost of having this happen. So, the real thing here is, my goal is to help you, be in a better place financially, just give you the information that will help you make the most informed decision for your finances and your bank account. So let's jump right into this. First things first, number one. So number one, the real thing that's gonna hit most people first is the mortgage rates. It's already happening even before the official rate increase that is expected in March. We're seeing this right now in the mortgage market. People are rushing out there purchasing homes just to beat this mortgage rate increase. It's already happening. So that's something you gotta prep yourself up for. You just gotta be ready. If you are ready to purchase a home right now and you found the home you like, you might just have to pull the trigger and keep it going. You may have to just lock in the rate, get into that property, and just close the deal. Because if you wait longer, chances are that you're going to have to pay a higher mortgage rate. Now, we're not going to get into the whole analysis of the price, what happens to prices when the rates go up, because this market is just a wild, wild west. No one knows, what's going to happen in the 2022 housing market, given the supply chain issues and whatnot. But my thing to you is, if you can, make sure you are locking in those rates right now, those lower rates before they go up. Okay, number two. Before we get into number two, right? We're going to talk about number two real quick. But before we get into number two, I just want to talk about just a quick, quick stuff on the bright side of this rate increase, right? Typically, when the Fed raises the rates, the interest you get on saving money in the bank typically goes up a little bit. Typically, right? And you're going to see your CD accounts, your money market accounts likely have a little better yield. But again, it's up to you. The money you have in your emergency fund, that would be the good thing. Seeing the, little more interest payment. It's not enough to, make a significant difference, but it could, it could help a lot of people just get that satisfaction that they have more growth on their money. So that's the bright side. Now let's keep going on the downsides of this very stuff. So number two, when it comes to the higher interest rate, this translates to a higher auto loan payment. So if you are in the market to purchase a new vehicle, you have to expect to pay higher in your monthly financing cost because your interest rates are going to shoot up. So you got to stay ready right now and pull the trigger. If you are ready to make a move, you have the money to purchase a new property, you have to pull the trigger right now and purchase that vehicle. Because again, the rates are going to go up. So this is the number two place where we're going to see a negative impact of the federal interest rate hike. Now, number three is equally important, right? Number three has to do with your home, real estate. And this is the HELOC, the home equity line of credit. If you have a home right now that has a lot of equity and you're wanting to tap into that, now may be a good time for you to go out there and get that HELOC. Because what happens when you have the interest rate hike? Your rates on the HELOC, the cost of having your HELOC will go up. So whenever you tap into your HELOC, you're going to have to pay more money to use that home equity line of credit or to access that home equity line of credit. It's just what happens when the rates are up. So you may have to go in and get that HELOC. Now, of course, you got to talk to your financial advisor and make sure it works for your personal situation and your financial situation. So let's talk about number four. Number four is one that millions of Americans actually fall under. This impacts a whole lot of people globally and especially in the United States. So this is basically your credit card charges. We've talked about how your credit gets impacted when you carry over balances. But what happens when you have periods of higher interest rate? When your interest rate is higher, your credit card company or your lender or the financial institutions tend to charge you more because it's always a percentage of your balances. So the interest rate is going to be higher and your monthly balances or the monthly charges on your balances will be higher. So if you can pay off your credit card debt before you get this interest rate hike activated, right? Before this takes place, you got to make sure you've paid off your balances. But if you cannot pay off your balances, you got to pay down as much as you can. And do not put unnecessary charges on that credit card because it's only going to leave you in a worse place with this interest rate hike. So just something you got to be in the know. You just got to be basically be aware of, right? Whatever you want to call it, you got to be aware. Now you know what the impact will be on your credit card. You got to take action accordingly. Number five is also something that impacts a lot of people, mostly people who are exposed to the markets. So if you are an investor, number five applies to you. Or if you're a prospective investor looking to get into the market, this is something that you got to pay close attention to. And this is basically you having lower returns on your investment, especially with the stock market. If you are invested in the stock market right now, you've basically, or if you were invested in 2020 and 2021, you've basically seen insane returns, right? Everyone was a genius in this, past few months, and people were just making money. But with this interest rate hike, you're going to see a squeeze and compressed returns, most likely because, again, you're not going to see the cost of borrowing money is going to go up. So that will slow down growth for most of these companies. And that translates to what investors get in return. So you got to pay close attention to the stock returns. This will get impacted. Look at your portfolio, talk to your advisor, your financial advisor, or your wealth manager, and plan accordingly when it comes to investing your money in the market. I'm not saying pull your money out of the market. I'm just saying you got to look at your portfolio, see how diversified you are, and just do some deep dive into your portfolio before you go out there, thinking that you'll be getting the same 2020 and 2021 returns. Last but not the least is a decline in existing bond value. So typically when the interest rates go up, you're going to see higher bond rates, right? You're going to see newer bonds that will pay you higher than the existing bonds. And then conversely, when interest rates go down, you're going to see, an increase in the value of existing bonds. So if you have a bond that's, not yet mature, you're basically going to have to reassess or take a deeper look at your situation if you're a bond investor. But yeah, the existing bonds are just going to go down because they cannot compete with the new bond. So the value of the bond you're holding right now, if you've invested in bonds in the past few years, It's not going to be as good as what you're going to see, the new bond that will hit the market. So these are some of the very important things that will get you prepped up for this interest rate hike. But again, you know, the goal of this federal interest rate hike is to tackle inflation. Now, no one knows how many times the rates or what the rates will really be, but the expectation from the past announcements and from experts is that this could happen as soon as March of 2022. So we're just going to be watching this and seeing how things go with this. Again, do not panic. Just take action. Be prepared. Take action and get yourself in the right position to succeed with this federal interest rate hike. Let me know your thoughts about this in the comment section, and if you've gained some insights from watching this video, again, let me know by hitting the like button. Give this video a thumbs up to also help other people get this information quicker. Thank you for watching. See you in the next video and stay safe.